Good evening, everybody. Can you hear me, please? Can everybody hear me? Good, Charlene. Good, Cleo. Good, Lorraine. Taz. T. Wesley. Hello, Wesley. Russell, Samantha, Shay. Okay. Sharon. Hi. Okay. Okay. We are not going to waste time, ladies and gentlemen. What I will do initially is to go through the tutorial letter for May 2017 for the examination session. It reads, "Dear students, please make note of the following key areas and notes pertaining to the Financial Management 1 examination. You are reminded that the detail provided herein is merely a guideline for clarity and direction, and you are encouraged to complete the entirety of the module content as outlined in the learner guide." So you should complete the whole module as outlined in the learner guide. The exam structure. The paper consists of 6 questions. Unfortunately, I just photocopied what is 6. I don't know what the 6th question is. The paper consists of 6 questions, resulting in an examination total of 100 marks. Question 1 has 10 marks, consists of 10 multiple choice questions involving short calculations, basic accounting concepts and calculations, etc., from all study units within Financial Management 1. Question 2 is 17 marks, consists of theoretical application of accounting concepts from both study units 1 and 2. Furthermore, you will be faced with depreciation calculations as well as basic journal entries. Question 3 is 25 marks. You'll be required to do an analysis of the accounting transactions using the elements of the accounting equation. The question is derived from study unit 1 and 2. Question 4 is 25 marks. This question is based on study unit 2. You will be asked to calculate the balance of accounts taking into account necessary adjustments and to prepare a document that is included in a set of financial statements. Question 5 relates to study unit 3. You'll be required to classify costs, complete calculations based on those classifications, including a break-even point and margin of safety. That's what we are going to have. So, ladies and gentlemen, as I go through what we are going to be going through, I would like you to have your textbook and learner guide with you because I'm going to be referring to this. I will try by all means to address what is required on your exam. So there we go. We know what financial accounting is about. We know it's about gathering, analyzing, recording, reporting, interpreting. I'm not going to go in detail there because I want us to have enough time for question and answer. We know their users. Briefly, we know we have internal users, external users. Internal users are owners, managers, employers. External are customers, competitors, lenders, government, suppliers, investment analysts. Then you need to know the difference between financial accounting and management accounting. You need to know this in terms of which audience they address, what the objectives of each are, what is optional, segment reporting, what focus each one is on, format, how each is formatted, and the rules. And we need to understand the different types of ownership. We all know we have what is called a sole trader. A sole trader has one owner. There are no legal requirements. The liability is unlimited, does not have to be registered with any external body. Partnerships, is 2 to 20 people. Voluntary agreement, these people come together, agree, they come up with a partnership agreement or something that is called a deed of partnership. Unlimited liability, partners are jointly and severally liable for the debts. What do we mean? If they owe you, you can approach one of them. Tracy can't hear. I hope you know you will be helped by Ronel there. So we are saying these people come together with an aim of making a profit. What we mean by jointly and severally liable, if they owe you, you can approach any one of them or approach them jointly. You know, it does not have to be registered with an external body. Close cooperation, which is being wound off. So 1 to 10 people, a founding statement, legal requirements, there has to be a founding statement that lays down the legal requirements in terms of the CC's Act. The limited liability is limited. It is a separate person. What do we mean? We are saying when they owe, you can only take what is in relation to the business, but not everything. So according to Act 71 of 2008, no further registration of CCs is required. Companies, the owners are the shareholders, one or more people, they have to be a memorandum of incorporation that represents the founding statement. Their liability is limited. Shareholders are not liable for any debts unless the memorandum of incorporation or act states otherwise. Notice of incorporation and signature of the memorandum on the memorandum of incorporation and filing in which prescribed notice of incorporation is required. So they are legal requirements. Somebody was saying they can't hear. Tracy, can you hear now? Okay. The types of business activity. We have what we call service business, like plumbers, lawyers, and what I'm doing right now. I'm offering a service to you. Accountants, these charge a fee. You'll note that in their statements, you won't have anything like, sales, but you'll have fee income. Retail, wholesalers and trading, these will have sales. Manufacturers, these are the ones that transform raw materials into finished goods. Now we have talked about what an asset is. You know what an asset is. It's what belongs to the business. Read about that. Assets are divided into two. Those that are more permanent are called fixed assets or non-current assets. And then we have current assets. So an example of assets are debtors, stock, land and buildings, furniture, bank, fixed deposit, petty cash, prepaid expense, and income accrued. Liability is what belongs to outsiders, what we owe to outsiders. So present obligations resulting from past events, the settlement of which leads to decrease in economic benefit. Examples: long-term loans, mortgage bond, creditors, bank overdraft, expenses owing income received in advance. Non-current are those that are repayable in a period of more than a year. Current liabilities are those that are payable in about a year, in a period of a year. Owner's equity, that is the value of the business. It is the net worth of the business. Actually, we say equity. Some always use capital as equity, but capital is part of equity. It is assets minus liabilities. What you own less what you owe. That is the value of your business. Now, that equation that I talked about, where I said equity is assets minus liabilities, is the key. It is called an accounting equation, although there are books that refer to it as the balance sheet equation. Let's look at that. If assets then become equity plus liability. Equity becomes assets minus liability. Liabilities become assets minus equity. Let's look at that. If you are given assets and liabilities, then you can come up with equity, because equity is assets minus liabilities. From here, we have assets, which is 12,500, minus liabilities, 1,800. Your answer should be what I've written in red, which is 10,700. That is A. How I calculated it, I'm using the equation. I have to look for equity, and I know equity is assets minus liability. If you are given any two of those, you can calculate the third one. On B again, we are given assets as 28,000 and given liabilities as 4,900, and you are supposed to calculate equity, which is assets minus liabilities, which becomes 23,199. Then C, they've left out liabilities. You have been given assets and equity. We know that liabilities is equal to assets minus equity. So 16,800 minus 12,500 is 4,300. I hope you all have your calculators, please. On D, again, you are given assets and equity. You can come up with your liabilities. Assets are 19,600, equity 16,450. We know liabilities is assets minus equity. In this case, 19,600 minus 16,450, you get 3,150, which is liability. Finally, for E and F, you are to calculate assets. And we know that assets are liabilities plus equity or equity plus liabilities. So we've been given liabilities 6,300, equity 19,200. To get assets, we will have to add those two, which is 19,200 plus 6,300. So 6,300 plus 19,200, you get 25,500. For F again, you've been given equity 39,750, liabilities 11,650. Then you get your assets, which is 39,750 plus 11,650. That is the balance sheet equation or accounting equation. Now, your question 3, what is required on question 3? It says you will be required to do an analysis of accounting transactions using the elements of the accounting equation. This question is derived from Start Unit 1 and 2. Sorry, Shailene, you are saying B should be what? Let me check. 23,100. Yes, you are right. It was a typographical error. Sorry about that. You are right, Shailene. It shows you are alert. Guys, that one is 23,100. Okay, thank you very much, Shailene. So now we continue. Now we have a question that relates to what is required in your question 3. Something similar to that. I'm not saying that's what you are going to get, but that is what is similar. So I'm thinking instead of teaching, let's go through an example. This example reads, Nas Botha decided to start a company that would assist in the filming and broadcast of all major sporting events in South Africa. The company is called SuperSport Pty Limited and was incorporated on the 1st of September 2015. The following transactions took place. What we note here, ladies and gentlemen, we always have what we call a debit and a credit. Maybe first I'll come back to the slide. Let me go straight to so that you understand what I mean by a debit and a credit. You see? Usually, we have a debit and a credit. For all accounts that are receiving, you debit. For all accounts that are giving, you credit. For instance, if somebody had to start off his business by providing, like he did here, on number 1, Botha contributed 50,000 in cash and a vehicle worth 30,500 towards business. The cash was deposited into the organization's bank account. What this means is 50,000 cash and 30,500 is what is referred to as capital or equity. Capital should not always be in cash. It can be in cash or it can be as an asset. In this case, we are going to debit the cash with 50,000 and credit and credit capital with 50,000, debit vehicle with 30,500 and credit, capital with 30,500. This is how it's going to look like. Oh, sorry. I think I removed that slide. But I want you to understand what's happening there. We are looking at these transactions. I'm explaining them one by one. Is there anyone who doesn't understand what I'm saying? So receiving, we always debit. Wesley, we always debit the receiver and credit the giver. We are going to come to that. Then number 2. Okay, Wesley, we are going to come to that. Both are obtained a loan on behalf of the company from B2 Bank Limited to purchase filming equipment. The loan was for an amount of 120,000. In this case, he has started off what we call a liability. This liability will be 120,000. So which means if this money is going to come to the bank is going to receive. It's going to be debited by 1,200 and the loan is going to be credited. The loan from B2 Bank. We always debit the receiver, credit the giver. You may ignore interest on this loan. The money was deposited into the bank. So if the money was deposited into the bank, there are 2 accounts, the bank and loan. You debit bank, credit loan. I'm just explaining this. Number 3, received income in advance from the South African Rugby to film and broadcast the international rugby game between South Africa and New Zealand. The amount was 225 and was deposited into the company bank. So again, it means the bank was debited. And because this was an income, it's going to be credited. But it's not yet earned. It's received in advance. We are going to look at that. Number 4. I can't get you, Elaine. Elaine, you want a view of this? Sorry. Elaine, I'm not getting you. Oh, is the slide a blank? Then I think it has to do with the techno. Oh, sorry, Elaine. I'm sure Ronel will do something. I don't know what's happening. I don't know what's happening, guys. Let me move. Is it still blank? Or you can see. 5,500 was paid to hire a television camera for a rugby game. The filming equipment had not been purchased as yet, so this is a normal business expense. So what it means is, if it's an expense, we are going to debit the advertising and credit this amount. Sorry, 5,500 was paid. When you are paying, it means you are going to credit the bank and debit advertising. Debit the receiver, credit the giver. Paid cameraman 5% on the income earned of 50,000 for covering a cricket tournament. The income has been correctly recorded. So what it means, if you paid a cameraman, you debit the commission payable because it's an expense and credit the bank. Always debit the receiver and credit the giver. So they wanted it would come as indicate the impact of each of the above transactions, number 1 to 5, would have on the accounting equation of SuperSport South African Pty Limited. So that's what they want you to show. You show whether which account is receiving, which account is giving. An example in the format to be used is provided, like wages. For instance, let's say if wages are paid, 1,500 were paid to a casual worker for the year, it means the wages account is going to be debited and the owner's equity goes down. Expenses reduce owner's equity. Income increases owner's equity. Let's look at the effect of these transactions on the accounting equation. For instance, bought invoice books on credit. Invoice books are an expense. And what does an expense do? It reduces your owner's equity. And because you bought them on credit, it means they will be a liability. So this is how this one is going to be entered. Look at that. Number one, what happens? The equity goes down because invoice books are an expense. What happens? Liabilities go up. You now owe. Go back. Number two, bought a computer by check, 130,000. What it means is computer is equipment, which is an asset. Assets will go up. And again, another asset, the bank will go down because you bought a computer by check. So it is going to be assets go up, which is computer, which is equipment, it will go up. And at the same time, the money in the bank will go down. Nothing happens to equity, nothing happens to liability. Number three, cash received for services rendered. Here we are assuming that, this is a service industry. They are not buying and selling. It's not a trading. So you received cash, then it means the bank is going to go up. And what happens? Your equity goes up because that's income. That's what is going to be. On the third, that's what happens. The asset, because you received the money from the services rendered, it goes up. Equity also goes up. The value of the business goes up. Number four, paid the annual fire insurance by check, 2,400. What's happening? Insurance is an expense. So automatically it means that your equity will go down. And the check will also go down because you used money at the bank. Your bank will go down. This is what is going to happen. Your assets, which is bank, will go down. Your equity will go down because it's an expense. Not that an expense is an amount that is incurred in the running of the business. Then number five, received 200 from a debtor in part settlement to her account. We all know what a debtor is. A debtor is somebody who owes the business. Debtors are sometimes referred to as trading receivables or account receivables. So if they pay, debtors are assets, current assets. If they pay, it means that the money at the bank will go up. And again, remember, money at the bank is an asset, debtors are assets. And another asset called debtors will go down. This is what will happen. You see, the effect is on both, is on assets. One asset goes up, which is money at the bank. The other asset goes down, which is a debtor, because he has now paid what he owes the business. The last one, tenant paid monthly rental to KL Car Wash. We are assuming that, this rent, not assuming, we know this time it is the tenant paying us. It is not us that are paying out. So this is income. And we know that income will increase our equity. And it will also increase the money at the bank. So let's look at this. There, It means that the bank will go up, the equity goes up. So that was what I was explaining about the equation. Do I have any questions on this one, on that equation? Any questions? Has this been clear? Tracy, I don't know. Okay, if it's clear, if I get a clear, yeah, because I want you, if anything like this comes, nail it, totalize it. We are not yet debiting and crediting. We were just looking at the effects. Okay, I'm moving because we have no time. Okay. Now, let's talk about income. What do we mean by income? Income is what is earned. For instance, fee income. Income is earned during a particular period. What do we mean? There is always what is called an accounting period. So those 12 months that we are reporting for, the income that is earned can be sales, fees earned, rent income like the one where we say a tenant paid 500, interest income, service income, discount received. Discount received is where we buy goods on credit and then our suppliers, because we have bought in bulk, give us a discount. Commission received. Bad debts recovered. What are bad debts? Bad debts are expenses. We sell goods to our debtors and we know that sometimes some don't pay. And if they don't pay, we write them off as an expense. But however, this person might come back sometime and say, sorry, I owed you so much. I was out of employment. I've come to pay you. That's a bad debt recovered. It is now an income. Expenses. I already explained expenses. I said those were amounts incurred during a particular period, excluding drawings. Drawings are not an expense. They do reduce equity, but drawings are when you get money from the business for your own use. I've always given an example of PPPEEE. When you are given money to run a business by the government, then you decide to go and buy an expensive car. And that money is not used in the business. That becomes drawings. You have money in your business, you decide to throw a party for your son, 21st birthday party for your son. You are drawing. That's not an expense. That's money that you have taken for your own use. Expenses is money that is used within the business. Examples, salaries and wages, motor expenses, lighting and heating expenses, general expenses. Depreciation. What is depreciation? Is the loss in value through tear and wear. We will see that we have two ways of depreciating: straight line method, which is called fixed installment method, diminishing balance method, which is called reducing balance method. We are going to look at that. Bad debts are sometimes referred to as credit losses by some authors. Then we have insurance, interest expense. It can be interest on money that you have, a loan that you got from a bank. Remember, when they give you that money, that's not for free. You have to pay for that money. And what you pay is called interest. Then discount allowed, when you decide to give your customers a discount. Now, a balance sheet. What is it? What is a balance sheet? A balance sheet is what we refer to as a statement of financial position. It is a statement that shows assets, liabilities, and equity of a business on a given date. It will have the name of the business, the name of the statement, and the date. It shows the assets, liabilities, and equity or capital of a business on a given date. You find those in a balance sheet, which is sometimes referred to as a statement of financial position. Let's go to page 51 and 52 of your textbook and see how our balance sheet looks like. There is an error though on page 51. But anyway, all that I want you to do is what is on page 51 is the statement of profit and loss. But I want us to look at the balance sheet, which is on page 52. You will see that equation that we've been looking at. It starts off with non-current assets. Non-current assets are those that are of a more permanent nature, those that cannot be easily changed into cash. So we are looking at, yes, Charlene will go back to the 45 to 50 years, but I want us to start off with balance sheet because I want to try and explain balance sheet and link it, Charlene, to the, to the equation. Let's look at the assets. Non-current assets. We have equipment, which is 57,800. We have fixed deposit, sorry, that is that. And then fixed deposit of 10,000. So those two become 67,800. Then we have current assets comprised of stock. Stock is sometimes referred to as inventory. And then we have debtors. Then we have bank. When we add all those, they become 38,800, meaning that our non-current assets and current assets in total become 106,600. Then, remember we said assets is equal to equity plus liabilities. Now let's come to equity. Equity is 60,300. Non-current liabilities is 30,000. Current liabilities comprised of creditors is 16,300. When we add all those, they are exactly the same as our total assets. I wanted you to look at how a balance sheet looks like. That's a statement of financial position or a balance sheet. Can we now go to our income, which is on page 51? Our statement of profit and loss and other comprehensive income of Wesel stores. As Charlene had already corrected, note that your gross income, if you add it, it's supposed to be 45 to 50. It starts off with sales. These are called sales or revenue. If there were returns, you would say less returns. But here we assume there were no sales returns. What are sales returns? You have sold goods to your customers and they find that some of them are not suitable and they decide to return them to you. Those are called sales returns or returns inwards. In this case, there were no returns. Then less cost of sales. The difference between sales, if I go to China City, and when I'm going to China City, I use 200 rands and I spend 1,000 rands. It means the cost of the goods will be 1,200. When I decide to sell them, I might sell them for 2,000. That's what is called sales. And cost of sales is how much I have incurred to get the goods to where they are and to buy them. The difference between cost of sales and sales is called gross profit. Like here we have sales 135,000. These goods that you got 135,000 rands for had cost you 90,000, which means the gross profit was 90,000. Sorry, it was 45,000. 135,000 minus 90,000, you get 45,000. Then we add other income. In this case, they have interest income, but we can also have discount received. We can have bad debts recovered. We can have decrease in provision for bad debts or in allowance for credit losses. We are going to look at it if time permits. We can have commission received. Income in your trial balance is on the credit side and expenses are on the debit side. Assets are on the debit side. Liabilities and equity are on the credit side. Let me come again. I said assets carry debit balances. Liabilities will appear on the credit side. Expenses will appear on the debit side of your trial balance. Income will appear on the credit side. That's how you should notice those. Now, with that, we have our total gross income or total income, which is 45,250. Then we say less operating expenses. Expenses can be general expenses, it can be wages, it can be interest on loan, it can be so much, but not the interests are not operating. However, here they've just put them as operating. Then the difference between the gross profit and the expenses is net profit for the year. Now, the purpose of the comprehensive income statement is for us to know whether our business is running at a profit or running at a loss. We have done this already. We did this, sorry, we did this. Now, is there any question on how our comprehensive income statement looks like, how our balance sheet looks like? Would you at least come up with a balance sheet if you are given the assets, liabilities, and equity? Any question? I'm waiting. Any question? If there is no question, I'm continuing. Now we are going to the double entry. Eileen is typing. Our time is limited. Yes, we are going to do adjustments later. I'm just starting off bit by bit so that everybody understands. Okay, double entry. Double entry, we are saying our system is called the double entry, meaning that for each transaction, there is always a debit and a credit. There is always a debit and a credit. So we are looking at double entry now. The account for double entry, each account should be shown on a separate page. What do we mean? Furniture account should be on a separate page, motor vehicles on a separate page, data shown on a separate page of the debtors ledger. You know, we have everybody having his own page. Each account should be shown on a separate page. The double entry system divides each page into two. The left-hand side is called the debit side, while the right-hand side is called the credit side. The title of each should be written across the top of the account at the center, like that. You see? I'm sure you can all see that. We have the credit side, we have the debit side. The left-hand side of the page is the debit side, the right-hand side is the credit side. Then accounts. Assets carry debit balance. To increase an asset, you debit. To decrease an asset, you credit. Liabilities carry credit balances. An increase in a liability is credited. A decrease in a liability is debited. Capital, like liabilities, which is part of equity, carries a credit balance. To increase, you credit. To decrease, you debit. Then we note that for assets to increase, we debit. Liabilities to increase, we credit. Then equity, it wasn't supposed to be credit, it was supposed to be equity, sorry. Then to decrease assets, we credit. To decrease liabilities, we debit. To decrease capital, we debit. Remember, for every debit, there is a credit. Always debit the receiver, credit the giver. Write that there. Always debit the receiver, credit the giver. You cannot debit and debit. You cannot credit and credit. For each transaction, there is a debit and there is a credit. Let's look at revision, a question on 2.1, page 37 of the learner guide. Let's look at that. It reads, let me see whether I did that. I didn't do that, sorry. So it reads, the owner deposited 8,000 on him on money into a bank account in the business name. I said you debit the receiver, credit the giver. Are we all on page 37? So what does it mean? We're going to debit the bank and credit equity. That's your number one. Debit bank and credit equity. Debit the receiver, credit the giver. Number two, the owner borrowed 2,000 cash from her sister. So the money received, you're going to debit your bank and credit liabilities because your sister now becomes your creditor. It's a liability. And then number three, purchased a cell phone and paid 1,200. So if the cell phone is for the business, you are going to debit your asset, which is cell phone, and credit cash because, sorry, and credit, yes, you paid 1,200. You credit the bank. And then number four, purchased a table and chair set and paid 950. You debited your furniture because it received and credited the bank, which is still under asset. And then five, purchased 2 briefcases for 6,000 cash. It depends on whether this business was for selling briefcases, but however, if you used money, you are going to debit if it was assets, which is 6,000 each, which means, sorry, it was for 600 cash, 2 briefcases for 600 cash. So you debit 600 for asset and credit another asset, which is bank by 600. Received 60 rands interest earned on the current bank account. So your bank has received 60 rands and you credit your equity because it's income earned. Number five, purchased 30 briefcases. Oh, sorry, we purchased, number five, I left it. Purchased 30 briefcases and paid 3,600. So we are going to debit assets because it's stock and credit, the bank by that amount. Yes, thank you, Leo. So now we continue. I hope we are on time. I want us to go to our adjustments. You were asking about adjustments. What are adjustments? If you know that we always have what we call a pre-adjustment trial balance. If I can recap, we always start off, accounting is the systematic recording of business transactions in the books of accounts. We always start off with a transaction. From a transaction, we get what we call a source document. A source document like an invoice, a cash register slip, etc., etc. Then we post that information to our journal. Then we post to the ledger. From the ledger, we come up, we balance off the ledger, and after balancing off the ledger, Wesley, I don't know what you're talking about. Okay, I was still explaining the accounting cycle. From the ledger, after balancing the ledger, we come up with a trial balance. Because there is a debit and a credit for every transaction, these are supposed to balance. But however, the fact that they balance doesn't mean that they are correct. You could have left out a transaction or transposed the figures. Instead of 93, you put 39. We have what we call a pre-adjustment trial balance, where after coming up with this trial balance, we discover that there are things we left out. And then we need to look at the adjustments. So I've explained the accounting period. If our year starts in January, it will end in December 31. If it started in if it started on 1 March, it will end at the end of February. Our accounting period is 1 year. In South Africa, mostly the year ends in March. Accounting period. We believe in accrual. Our accounting system is on accrual basis. This implies that incomes are matched with expenses in the period for which they relate. It ensures that all incomes earned and expenses incurred are recorded in the period to which they relate and not when the cash is received. Note that even if you sold goods this year, even if it was by credit, you'll record them as sales because of the accrual basis. Please read and understand accrual basis. Let's look at question 2. Consists of theoretical implications of accounting concepts from both study 1, unit 1 and 2. Furthermore, you'll be faced with depreciation calculations as well as basic journal entries. Why I'm bringing this out is because depreciation is also part of adjustments. Adjustments, you'll note that you'll have bad debts, you'll have depreciation, you'll have accrued income, which is income that you were supposed to receive but you never received. You'll have, income received in advance. You might also pay expenses in advance. All those fall under adjustments. So question 2 has to do with adjustments, but they've put special emphasis on depreciation. Depreciation. What is it? If you bought your car for 100,000 last year, is it still 100,000? It has obviously lost value because of its being used. So it is a loss through tear and wear of a non-current asset. Non-current asset is a fixed asset. Methods of calculating. We have straight line method, which is sometimes called fixed installment method. We have diminishing balance method, which is sometimes called reducing balance method. Straight line method has a formula, which is cost minus residual value. Residual value is what remains at the end of its useful life that you can sell as scrap value over the estimated number of years. And this becomes depreciation per annum. This is what happens. Let's say if there was no residual value, we decide to depreciate this equipment that had cost 100,000. It means every year, if it's 10%, it will be 10% of cost. You'll be depreciating it by 10,000, 10,000, 10,000, 10,000 until the final year. That's what is referred to as straight line method or fixed installment method. When it comes to diminishing balance method, it is also called reducing balance method. It is calculated on a percentage of the net book value. Net book value is sometimes called CV, which is carrying value. So NBV is cost minus accumulated depreciation. This year it depreciates by 10,000. Next year it will be another 10,000, which means the accumulated depreciation at the end of the second year will be 20,000. End of the third year will be 30,000. End of the fourth year will be 40,000. That's accumulated depreciation. Example, year 1, you depreciated by 10%, which was 10,000. The book value became 100,000 minus 10,000, it was 90,000. 10% of 90,000 is 9,000. Third year, it will be 90,000 minus 9,000 becomes 81,000. 10% of 81,000 becomes 8,100. 81,000 minus 8,100 becomes 72,900. 10% of that, you continue that way. That is what is called diminishing balance method or reducing balance method. Journals. A journal has a debit side and a credit side. We always start off with an account that is to be debited and then end up with an account to be credited. You remember I said for each transaction there is a debit and a credit. For instance, let's process depreciation. When you note that you have depreciated by, let's say, 10,000, You are asking, Shay is asking whether we include the installation costs. We do include installation costs as part of the cost of that machine, but not at this level, you don't cover that. Please, at this level, you don't cover that. It's very basic at this level. So what's happening, Shay, is what we are going to do is you debit depreciation and credit accumulated depreciation. Accumulated depreciation will always be carried forward, but depreciation will be transferred to your profit and loss account to appear with other expenses. Every year your depreciation will appear there, but the accumulated depreciation is always carried down. Statement of financial position. What it means is if your equipment was 100,000 and it has accumulated by 40,000, in your statement of financial position, you'll show equipment 100,000, accumulated depreciation 40,000, cash value or net book value 60,000. The same applies to motor vehicles. If you had bought them for 200,000 and they've depreciated by 120,000, accumulated depreciation, the net book value will be 80,000. Allowance for credit losses, what is it? It's sometimes called a provision for bad debts. We know that, from experience as a business person, you know that usually there is a certain percentage of your debtors that don't pay. So you do what is called a contingent liability. You already set aside a certain amount from your profits to say, no, I know usually 5% of these people don't pay. This is called a provision for bad debts or an allowance for credit losses. It is only created once. If, let's say, this year our debtors were 100,000 and we are setting a provision for bad debts at 5%, it means that 5% of 100,000 is going to be 5,000. But that doesn't mean that next year, obviously in your provision for bad debts, it will show 5,000. But next year, your debtors might come down to 80,000, which means it has to be 4,000, meaning you reduce it by 1,000. If it is a reduction in provision for bad debts, you are going to add it on other income. You are going to add it to the gross profit. It will be other income. But let's say next year, instead of it, you have set aside 5,000. Next year, your debtors become 120,000. 5% of 120,000 is going to be 6,000, which means it's increasing. You are like creating an extra 1,000 that is going to appear with the bad debts on the expense side, on the profit and loss. Here, situations relating to bad debts. When you write off a bad debt, you know who it is that is defaulted. So what you are going to do is you are going to debit bad debts account, which is an expense, and there was supposed to be debit credit there, guys. And then credit the person who has defaulted, or debtors control. Debtors control is a total of all your debtors. So we always have bad debts is an expense. So if you are writing off a bad debt, you know the expenses go up and you cancel off the person that was there by crediting them. You debit your bad debts, credit that person. When you are creating a provision for doubtful debts or allowance for credit losses, you will always debit a bad debts account and then credit a provision for bad debts. That one will be set off against debtors control. It's always carried down. When you are increasing a provision for doubtful debt, you will debit the bad debts and credit the provision for doubtful debts. When you are decreasing a provision for doubtful debts, you are going to debit the provision. Remember, provision for bad debts carries a credit balance. So when you are decreasing it, you will debit it and then credit a bad debts account, which is, you're now decreasing the expense. Scenario. On 2 January 2015, the organization paid upfront for advertising space on a billboard that would run for 4 months from that date. The cost for the space is 12,000 per month. The year end was 31 March 2015. So if the year end is 31 March 2015, what does it mean? We are saying this is going to cover 4 months, which is going to be January, February, March, April. This is 4 months, but not our year end is 31 March, which means if it's 12,000 per month and they paid for 4 months, they paid 4 times 12,000, which is 48,000. But not the year ends on 31 March 2015. What does that mean? That means they've paid in advance. How much have they paid in advance? The 12,000 for April. So let's see how we treat it. This is an adjustment. Look at this. When they paid, we always debit the receiver, credit the giver. We debited advertising expenses, credited bank. But there is a 12,000 which has been prepaid, which means the advertising expenses to be reduced by 12,000. How do we treat the adjustment? By coming up with an account called a prepaid expense and crediting. Remember, it is 48 on the debit. When you credit it by 12,000, the balance is now going to be 36,000, which is going to be an expense. That was now an expense that was paid in advance. Now let's say we have income received in advance. On 4 March 2015, we received 60,000 cash in relation to a service contract to be completed over 2 years. Only 6,000 worth of the contract work has been carried out by the year end, which was 31 March 2015. So we are supposed to have earned only 6,000, which means the balance has been income received in advance. So when we received it, we have received the 60,000, but we haven't earned it yet. We haven't worked for it. Contract income, 60,000. Then, because they are saying this is supposed to be covered in 2 years, if you could get your calculators and check 60,000 divided by 24 months is supposed to be 2,500. It's supposed to be 2,500. Now, how many months has it been, by the way? Only 6,000 worth of the contract work has been carried out by the year, which was 31 March. So we look at that. We have our bank, we have recorded it. I'm now looking at that. If you look at 60, because it's only been 1 month. If you look at 60,000, if you say 60,000 minus 2,500, you get your 57,500. So you have contract income, that income received in advance becomes 57,000. So it's supposed to be 57,500 typographical. We are looking at the 1 month only that was supposed to have been earned, because the 60,000 was supposed to be for, I shouldn't have put the 6,000 because it will confuse you. But however, just take it, the 60,000 was for 2 years. So far, they've only worked 1 month, which means it's supposed to be 2,500 per month. Accrued income. Rent received is 22,000. Additional information, the rent only been received for 11 months. So if this rent was only for 11 months, how much is it per month? It means per month we say 22,000 divided by 11. If we could calculate that, 22,000 divided by 11, we get 2,000. So it means the 12th month, remember our year is 12 months. Accrued, it means income owing. These guys still owe us 2,000. And then we credit rent. This was rent income. Income received in advance. By the way, when income is accrued to us, it's an asset because these guys owe us. But when we have received their money in advance, we owe them for the service. The following information was extracted from the records of ABC traders for the financial year end 28 February. Rent received was 26,000. Additional information, the rent received includes March 2021. So it means this is for 13 months because the year ends in 28 February. So we have to remove the 1 month. So how do we know how much it is a month? We say 26,000 divided by the 13 months. So the 2,000 has been received in advance. Ideally, we should have only received 24,000, which is 2,000 per month. This is how it's going to be. We're going to have rent received and income received in advance. But when we received it as 26,000, we debited the bank and credited income received. And now to correct the adjustment, we debit rent received and credit, income received in advance. We now have a new account called income received in advance. This income received in advance in your balance sheet is going to appear as a liability. Now let's look at question 4. This question is based on study unit 2. You'll be asked to calculate the balances of accounts taking into account necessary adjustments and to prepare a document that is included in a set of financial statements. We know the financial statements that we know. We have what we call a statement of changes in equity. Statement of changes in equity, we look at what our equity was at the beginning and what it is at the end. What changes our equity? Equity, opening equity, add net profit if it's a less drawings, and then we get our final. If there was additional capital, we add it. Cash flow statements, these ones will be looking at where our cash came from. They are trying to explain the opening cash balance and the closing cash balance. We are going to look at that. Statement of profit and loss and other comprehensive, you have looked at that. We have looked at that. Now let's continue with our, yes, I see Charlene is typing. Before we go to our statements, I would like to talk about perpetual inventory system and periodic inventory system. Perpetual inventory system, in most cases, we are going to look at cash flows, my dear Shailene. Step by step, we are getting there. That is time permitting. Okay. Now, let me explain about perpetual inventory system. Perpetual inventory system, usually you are given the cost of goods because they're in such a nature that it's easy to say the cost is so much. You have noted that sometimes in some questions, you are given the cost of goods. But with periodic inventory, note that they might give you the opening inventory, give you the amount of purchases, give you the carriage on purchases, give you the freight on purchases, give you the returns, give you the sales returns, then they ask you to come up with the cost of goods sold. That would be periodic inventory. Let's look at page 51. And I think we did look at page 51 already. We looked at example 1 and 2. I'm not going to look at that now. Yes, we did, my dear Charlene. because I was coming to that statement of cash flows now. Cash flows, we have our cash flows in 3 sections. We can have cash flows that comes from our operations. For instance, IMM gets its cash flows from the fees operating, that is when they teach and they give out modules, that's from operating. Then it can be from investment activities where they've put their money in different investments, and that will be cash flows from investment, or cash flows into investment when they decide to expand this place, buy more machinery, buy more buildings, that is investment. Then financing activities would be when they get money maybe from issuing shares or from the bank if they get a loan. Then that is from financing activities. Financing activities can be from own capital or from the loan. So statement of cash flows. These tell where the cash came from, went to, what happened to the statement of financial position for the period in question. It explains the changes in one balance sheet item, that is profits equity. The cash flow statement explains the sources from which the firm acquired the funds and where it used them. That's what the cash flow is doing. I've explained what equity, statement of changes of equity is. I've explained comprehensive income. We have looked at it twice, page 51 and 52. We have looked at the balance sheet. And now we are explaining cash flows. I've said the money can come from operating activities or go to operating activities. It can come from investing activities or go to investing activities. It can come from financing activities. Or when we pay loans, it's going to investment activities. Sections in the cash flows, I've already explained this. Cash flows from operating activities, cash utilized in investing activities, cash flows from activities, financing activities. And then what is cash and cash equivalent? Like petty cash is a cash equivalent, or 32-day deposits, those are cash equivalents. Cash at bank is cash in cash equivalent. Now, the following is an extract of the trial. This is now, sorry. We are going back now to our adjustments. The following is an extract of the trial balance of Snappy Snacks Limited for year ended 30 June 2014. I just briefly explained about cash flows because when I looked at that tutorial guide, it didn't have much. They said you will not be asked to construct a cash flow statement, but you will be asked to come up with it. So Charlene, Shay, and everybody there, I am trying to zero more onto what, the tutorial letter says might be there, might be related to what might come. Not exactly what's going to come, but I'm thinking there are certain things that I should not ignore. When it comes to that one, even the study guide says you just have to, know those components. Now, the following is an extract of the trial balance of Snappy Snacks Pty Limited for the year ended 30 June 2014. Look at this trial balance. Income, all incomes, you note that they are on the credit side. All expenses are on the debit side. Assets are on the debit side. Liabilities will be on the credit side. That's the trial balance that you have been given. I'll be going forward and backward so that you understand what we are doing. The following adjustments still need to be taken into account in preparation of the financial statements. Only 10 months of rent was received and included in the trial balance. Only 10 months. Let's go back and see. There is the rent received. It was 22,000. And they say this is only for 10 months. If you could get your calculators, if they say we have only received, which means 22,000 divided by 10, which means a month we are supposed to be receiving 2,200. What does it imply? We receive 22,000 and that's only for 10 months. So what it means is there is still accrued income from rent. These guys owe us for 2 months, which is 2,200 times 2. Then it means in our which means in our comprehensive income statement on other income, we are going to show on the side rent income 22,000 plus 4,400, meaning that our rent income should be 2,200 times 12, which is 26,400. I hope I'm loud and clear. We saw that we had received 22,000 and 22,000 was for 10 months. To get to know how much a month is, I say 22,000 divided by 10. I got 2,200. A year is 12 months. So which means we have 2,200 for the times 2, which is still owing. So what we are going to do is when we add to our gross profit, we are going to have rent income 22,000 plus 4,400. And our income is going to be 26,400. I've done that. I'm now going to the next adjustment. Stationery unused on 30 June 2014 was valued at 200. When we go to our trial balance, you see our stationery is 800, but we are told that there was unused stationery of 200, which means the expense of stationery for that year was 600. So under expenses for stationery, we are going to have 800 minus 200 is going to be 600. C, commission amounting to 1,600 was received in advance. If it's in advance, it means it's not earned this year. It has been paid in advance. Let's see how let's look at our commission there. You see, we have received commission 11,200, which means the 11,200 is including the 1,600. So what we are going to do is we are going to have 11,200 minus 1,600 because 1,600 does not belong to this year, it belongs to next year. So under other income, our commission is going to be that minus 1,600, which is going to be 9,600 if I'm right. I hope you all have your calculators. Then D, an additional amount of 400 must be written off as irrecoverable due to debtor being declared insolvent, which means it's a bad debt. Already with debtors, with bad debts, which were 750. Now in our profit and loss account, we are going to have 750 plus 400. Our debtors have increased. So an amount 12,500 must be raised as a provision for bad debts. We know when we are raising it, it means it was not there. If we could go back, we never had provision for bad debts. So it's coming up for the first time. So what it means is we are going to add our, if you remember our double entry, we are going to add to bad debts the 400, which was an additional bad debt, and add the 12,500, which is now a provision for bad debt that has been raised. Then depreciation on machinery has been correctly calculated for the year at 50,000. No entries have been processed for this amount as yet. sorry, it's supposed to be an invoice for water and electricity has not yet been, oh, sorry. I think the depreciation account will now be put as 50,000 under your expenses. There was, I think in my typing, an invoice for, that is G, just disregard this small bit typographical. The June invoice for water and electricity still not been paid, which means it's owing. It was supposed to have been paid this year. We will have to add it. Let's see. Water and electricity. Do we have water and electricity? Yes. So we have to add it to the 4,500. In our expenses, water and electricity are in expense. So we will have to add that to the 550 to 4,500. H. Interest expense on a loan from the bank is calculated at 12% per annum. The loan was received on 31 December 2013 for an amount of 10,000. As at 30 June 2014, no capital repayments have been made. The loan was 15%, it was 10,000. But let's look at how long it has been there. Our year ends in 30 June. And ending in 30 June, we know that the loan was 10,000. But let's see, how long has it been there? Be very careful. This loan, it could have been 15% times 10,000 had it been there for a year. But this loan has not been there for a year. It's only been there, look at the date, 31 December, so we don't count December. So it's only been there for January, February, March, April, May, June. So how do we calculate it? It is going to be 6 over 12 because it's only been there for 6 months, times 15 over 100 times 10,000. If we look at that, I said 15% times 10,000 times 6 over 12. It means the interest on loan is going to be 750. That's what is going to be our interest expense. Questions, people? I'm expecting questions on interest. It was there for January, February, March, April, May, June. It was 30 June, which was full 6 months. And they say the interest is calculated at 15% per annum. This is not an annum, it's half an annum, which is 6 over 12 times 10,000 times 6, 15%. Enter room. I see there's somebody called. Let me re-explain, guys. Roshan, the loan is 10,000. Write it down, 10,000. If it had been there from the beginning of the year to the end of the year for 12 months, we would have said the interest is 15% on 10,000. It was going to be 1,500. But in this case, it's not 1,500 because this loan has only been there for half a year. How do I know it's half a year? They say the loan was received on 31 December. So it's only been there for January, February, March, April, May, June, which is 6 months. So the loan is going to be the interest is going to be 750. Charlene, how did you get 9,000, guys? I have said it is 15%. Let me type it there for you. It's 15% times 6 over 12 times 10,000. 15 over 100 times 6 over 12 times 10,000, which means it's going to be 750. Let me move. We might not finish. Shay is typing. Yes, good. That's you, Shay. Very good. You were supposed to come up with an income statement. I picked this from a paper in 2014. That's how it was. So I thought I should explain it. Now let's go to company terminology. We are now talking about public limited companies. We have private companies. Before, we looked at the types of ownership. And when we talk about the share capital, we know that when you are a public limited company, you are allowed by the registrar of companies to issue shares to the public. You have to file with the registrar of companies certain documents. And share capital is the amount of shares that you have issued to the public. What happens is we have different types of shares. We have ordinary shares. The people that buy ordinary shares are called ordinary shareholders. We have preference shares. The people that purchase preference shares are called preference shareholders. The difference between these is the ordinary shareholders are allowed to vote. The preference shareholders are not allowed to vote. Preference shareholders can be Class B and Class C shares. They receive a fixed dividend. Ordinary shareholders don't have any fixed dividend. If the year is good, they can receive a lot. If the year is bad, they carry all the risk. So when money is being paid out, when profits have been there, you don't issue out everything. You leave some for your own reserves, you retain some in case next year is not okay. So authorized share capital is how much the company is allowed to raise from the public. When they are raising from the public, they don't always issue the whole of authorized share capital. They go to the drawing board and say, okay, we've been given 10 billion to raise, but we only need 100 million. That will be for our first building, office, the workers, the machinery, for starters. We are going to be issuing as we expand. So issued share capital is that part of authorized share capital that has been issued out, subscribed for. Share premium. Shares have what is called a nominal value, although now the thing is they sell them without a nominal value, which is called a par value. If a share was selling for 100 rands each, and the company is doing so well that the shareholders are getting so much dividends, and obviously the market price is going to go up. The law of supply and demand. People are going to need those shares. They are going to scramble for those shares, meaning that even if those shares are sold for 120, when the nominal value was 100, people are going to still buy them. So the difference between the nominal value and how much they are going to be sold for, if it's 120, the 20 rands is going to be what is called share premium. It's part of equity like share capital. Types of shares I've explained. Dividends, these are shares of profits that are given out. I say preference shareholders received fixed dividends, but ordinary shareholders don't receive any fixed dividends. When profits are made, the first to be paid are preference shareholders, as the name suggests, they are the preferred. Reserves, we have different types of reserves. When profits are made, the directors who are asked by the shareholders to run the company might decide to put some amounts onto different reserves. I've talked about the class of shares. Reserves, we have non-distributable reserves. Read these: distributable reserves and general reserves. Equity structure, let's go to page 60 of the learner guide. What we are looking at on page 60, you'll see how equity looks like when it's in a sole trader. We always have opening balance, which is, that is the changes in equity. Capital contribution, if you put some more, then plus profit, less drawings. But here, if it's companies, we have Class A shares, we have that. Class B shares, we have that. And then these are the issued. They fall under share capital. Remember, this is now from the shareholders, who are the owners of the company. Then we have what we call retained earnings. As I have already explained, we don't always issue out all our profits. We keep some of the, earnings for another time when things are not okay. So we always start off with the opening balance. I'm looking at the New Companies Act, the one below. We always have the opening balance plus net profit after tax, opening balance being what you had last year's retained earnings. Then you add this year's net profit, then you less to reserves, then less dividends, both ordinary and preference, and then you remain with what is called your retained earnings. That's how the structure is going to be. That's the equity structure. Understand that, please. Highlight that. We have already looked at, now let's look at page 61, the statement of profit and loss disclosure. Remember, when it comes to trading profit and loss account, which is the comprehensive income statement, it is exactly the same as the one that we have been doing, the one that we looked at on 50 and 51. But here we will have now net income before taxation. Look at that example there. And then less taxation, then net income after taxation. Then it is that amount that we transfer to reserves, transfer to preference shares, transfer to ordinary shares. Then we have the retained income for the year, and we add what we had from last year, and we have our retained income at the end of the year. Let's look at question 5. They say question 5 now is about costs. You will be required to classify, we have about 45 minutes to an hour. You will be required to classify costs and complete calculations based on those classifications, including break-even point and margin of safety. Let me explain. Break-even is where your costs are equal to your income. Where you don't make a profit, you don't make a loss. For you to calculate break-even, you should know what your fixed costs are, and you should know what your variable costs are. So you should know what contribution per unit is. Contribution per unit can also be referred to as marginal income per unit, which is sales per unit less variable costs. So that figure should be dividing into fixed costs. Let's see. What are costs? We know that we have 3 costs: material costs, we have labor costs, we have overhead costs. Sorry. Can you all hear me? Because something happened in my computer. Are we together? Okay. Okay, something happened to my computer, I don't know why. Costs, that is value of economic resources used for production of a product or service. These can be viewed as a necessity in producing a product or service. Those are costs. If you look at this, the cost of coming up with this water will be the purification of the water, the bottle, and everything. That is a cost. Direct costs. Direct costs are costs that can be accurately identified as forming part of the cost center. For instance, in the bottle that I showed you, water bottle, a direct cost, the plastic that is there and the paper that is there is the direct cost, because we can trace it to the final product. Examples, materials used to make the product. Those are called direct material. Direct labor is the people that are actually holding the product and coming up with the product. Indirect, for instance, in a factory where they are making the water, they can be supervisors. They are not the actual laborers that are holding. Examples of indirect can be depreciation of the production machinery, factory supervisor's salary. Fixed costs, they are those that don't change. If, let's say, I'm teaching in a classroom and I'm renting the classroom for 1,000 rands. If there are 2 students, I'll still pay 1,000 rands. If there are 20 students, I'll still pay 1,000 rands. An example of fixed costs are rent and insurance. Salaries are fixed costs as well. Variable costs, these change. The costs that change in proportion to the changes in the level of output. I make a dress from 2 meters. If there are 2 dresses, it will be 4 meters. 3 dresses, it will be 6 meters. 4 dresses, 8 meters. That's a variable cost. Examples is direct material, direct labor. If you work 1 hour, you receive this much. 2 hours is double. 3 hours is 3 times. You see what I mean? Direct labor and certain variable overheads, e.g. packing materials. There are those that are called semi-variable, which have got both the fixed component and the variable component. Manufacturing costs comprise of direct material, direct labor, and manufacturing overheads. Included in manufacturing overheads are indirect materials and indirect labor, like the supervisors that we talked about in the factory, like the crane drivers that we talked about in the factory. Those that are expenses that cannot be directly attributable to the finished product, that you cannot see. They're attributable, but you can't see them in the finished product. They can't be traced. Material, there's direct material and indirect material. Labor, direct labor and indirect labor. Manufacturing overheads, excuse me. Manufacturing overheads. These include all indirect material, indirect labor, and other costs incurred during the manufacturing process that cannot be directly traced to the products. Non-manufacturing costs, we're talking about marketing costs, selling and distribution, and administrative costs, that is for the administrators, for the accountants, for the marketers, all that. So I would like you to read on page 68, opportunity costs, common costs, sunk costs, committed costs, what those costs are. Now, let's look. I think I have an exercise that talks about these costs, but I'm rushing to break-even point. Break-even point. It refers to the revenues needed to cover the company's total amount of fixed and variable expenses during a specified period of time. The revenues could be stated in dollars or other currencies, in rands, we should say rands, in units, hours, or services provided. What is contribution or marginal income? Sales per unit minus a variable cost is what is called a contribution per unit. We should know. Wesley, is everybody not seeing the slides? I think the technical guys should say. So Wesley, it must be your problem because everybody can see then. Wesley. Okay, Wesley. Now let's look at the break-even quantity. It is the same as break-even point. That's where your total fixed costs are. Where you don't make a profit, you don't make a loss. Margin of safety is how safe you are. If you produce 10,000, if your break-even quantity is 7,000 units, but you are producing 10,000 units, your margin of safety is going to be 3,000 units, which is 10,000 minus 7,000. So Margin of safety is budgeted sales minus break-even sales over budgeted sales times 100. We are going to look at that. Don't bother. We are going to look at it. Margin of safety, I've explained it. Let's look at this. Orlando Pirates Limited, that's a question that's related to that. Manufactures soccer balls. The operations director has sourced a new material that will make the soccer balls more durable. However, this material is more expensive than the current material used to manufacture the soccer balls. The following information is available in respect of the soccer balls manufactured with the new material. For instance, you have the selling price is 75 rands per unit. Direct material is a variable. Is 12 rands. Direct labor is 5 rands 50. Depreciation of machinery considered as a fixed cost. Depreciation is fixed. Rental of factory premises is a fixed cost. Delivery expenses, they say 300 to 100 units, means that's a variable. Required. Calculate the break-even point in units. How do we calculate break-even point? We first have to have marginal income per unit, which means it will be sales per unit, which was 75 rands, less variable cost per unit. And from what I can see, we will have to have the variable cost per unit determined. Let's see, we know that direct material is a variable cost, direct labor is a variable cost. Let's see. I should say that's the formula. That's the formula. Total fixed cost over contribution per unit. Contribution per unit is marginal income per unit. So now another variable was delivery expenses. If it's 300 rands for 100 units, it means then it's going to be 3 rands per unit. So we are going to add that to the current variable. So this is what we are going to have. Our total fixed cost, we had our depreciation, we had our rental, which means we are going to have 20,500. Now let's try and calculate our variable per unit. Sorry. Variable cost per unit. What is our variable cost per unit? It looks like I didn't. Our variable cost per unit is going to be 75 rands plus 12 rands, which is for materials, plus delivery expenses, which is 3. And then we have our direct labor, which is 550. So for us to calculate our contribution per unit is going to be selling price 25 less variable costs, which is less 12 rands, less 550, less 3 rands. Our contribution per unit is going to be 54.50. So now we are going to say fixed costs divided by 54.50, which is, it means for us to break even, we are going to have 376 units. Is this clear? We added the fixed costs and they gave us 20,500. We added the variable costs, subtracted them from the selling price per unit and got our contribution per unit as 54.50. And then we are saying fixed cost divided by the contribution per unit, then we get our break-even quantity. That's how easy it is. So please read and practice. Okay, I'm continuing. Thank you if you are happy. Yes, it gives us our break-even quantity because it can be break-even value. If it's break-even value, you get that value, multiply it by the 75, which is the selling price. Okay, clear? Okay, I'm continuing now, guys. Now you remember I promised, I said I was going to come back to costs because I wanted us to cover that. I'm worried about time, so I just want you to get everything. Yes, it's in units, clear. Question, in column A, I'd said read on those costs, but I've given you something. The question is, in column A is a cost terminology, and in column B is an example of the cost terminology. Mixed cost, they've given you cost terminology and given you example. What is a mixed cost? I explained to you, a mixed cost is a cost that can have a fixed component and a variable component. So that is a mixed cost. A sunk cost is a cost that is, that has already been, a cost that is no longer relevant. It's a past cost, it's historical. Variable cost, I've explained it. Fixed cost, I explained it. I said rent, depreciation. Committed cost, if you want to know what a committed cost here, you were supposed to try and see which one is which. For instance, number one, mixed cost. If you look at mixed cost, the best description for a mixed cost would be the municipality charges a fixed fee in respect of the first 100 liters of water used by the company. Thereafter, the water fee is based on the quantity. It's like your phone. There's a fixed cost. Thereafter, whatever you use, that then makes it a mixed cost. So, number one was supposed to have been paired with E. Then let's go to number two. Sunk cost. What is a sunk cost? I say it is a cost that has already been incurred. That does not help us in our future decisions. It would have been first described as marketing costs incurred in order to determine the profitability of the future product. So it's something that was already incurred. That becomes a sunk cost. Variable cost. A good example is the one that you see in B, the column B. Commission earned by sales staff. The more they sell, the more commission they receive. That's a variable cost. I gave an example of dresses. Then fixed cost, I've explained it. Committed cost. Committed cost would be best described as the company has entered into a contract with a supplier to purchase a specified quantity of materials, regardless of any future decisions the company may make. So this is committed. They've committed that they are going to pay that amount. So I just wanted us to have a feel. I had left it out deliberately. So they wanted you to choose which was the best. Now we have classified this. Classification of materials. We have direct material that you can trace to the finished product. We have indirect material. We have work in progress, which is partly finished goods. We have finished goods, then we have inventory. We have also costs that are carrying costs. Costs are, if you have stock with you, you incur certain expenses like security, etc. Ordering costs, stock out. Read this. Lead time is the time between ordering and receiving. Economic order quantity is, there is a calculation for that, which means which is the most economic order. Remember, we are trying to balance between stock out and too much stock. Economic order quantity is 2 times annual requirement times order cost over carrying cost per unit. It's the square root of that. You have to know this economic order quantity. I've seen it in so many papers before. Order point, you should know how to calculate order point, average stock, which is economic order quantity divided by 2 plus safety stock. Please read that. Then we have what we call stock valuation method. FIFO, which is first in, first out. LIFO, last in, first out, and weighted average. These you can see on your page 152 of the textbook. In fact, from 151 you have economic order quantity. Please practice that. Let's look at FIFO. I'll just go through FIFO for you to understand and weighted average. Your FIFO, the illustrated example, when first in, first out, we always issue out to production what came in first. For instance, on the first, stock on hand was 100 units at 10 rands per unit. This is what you see there in the example. Sorry. In the example, on FIFO, you have your 100 times 10, you get 1,000. On the third, you issued 40, which means you are issuing the first in. So far, you only have the 100. When you issue 40, you remain with the 60. They were all 10 rands, meaning that the value of closing stock is 600. On the fourth, you purchased 160, meaning that now your stock is comprised of the 60 that remained and the 160 new one, which were 12 rands, and you get that. So on the fifth, you are now issuing 40. So if it's first in, first out, they will come from the 60 because 60 has been there first, meaning that from the first it will now be 20. We continue. On the sixth, when we issue the 20 will come out. Sorry, on the 6th, we are supposed to issue 60. But we have the 20 that's still remaining. We'll start off with the 20. The next 40 will come from the next lot, meaning that from the next lot, we will now remain with 120. On the 7th, returned to supplier 20 units. So those that were returned to supplier will be subtracted. So it means that instead of them being 120, they will now be 100. Average, weighted average, what it does is it adds. For instance, we had 100 on the first, on the third we had 60. So what we do now, we are now having, on the first, we are starting off on the first, we had 100, it was 10, it was 1,000. On the third, we issued 40, which was from that we remained with 60. On the fourth, we had 160 at 12, which means now we will add 160 plus 60, it becomes 220. But what we do now is we add 1920 plus the 600 and get 2520 and divide by the 220 to get an average, which means now our average is going to be 11.45. Are you getting where I'm doing that? Remember, we have the 60 times 10 is 600. We now have that 160 times 12, which is 1920. In total, we now have 60 units that came from the last lot plus the 160. Our total units that we have now is 220 on the fourth. But their total cost is the 60 were 600, the 160 were 1920. When you add those two, 1920 plus 600 and divide by 220, the average is going to be 1145. So when we are issuing now, we are going to issue at 1145. On the 6th, when we issue again, it's still 1145. But now, because we have returned the 20, it will now reduce the amount because it will now be 240 from 1374 divided by 100, which becomes 1134. Please read that. We cannot go, otherwise we won't finish. We cannot go in detail. Please just, I see Ramokete. Ramokete, emphasize more on page 152, 153. Please, for you to understand that it is on 153. And they do explain it so much below, Ramokete. So we have done that. Now let's look at VAT. VAT. What is VAT? It's value added tax. And it's vendors. And there's VAT input, VAT output. Now, VAT is value added tax. Is an indirect tax levied by vendors on the supply of goods or services. The prescribed rate in South Africa is 14%. For certain goods, you know, you find that there is zero rate. They are read those ones, know which ones are zero rated and which ones are exemptors. Who is a vendor? A vendor is the one who collects VAT from customers to pay to SARS. The vendor can claim back any VAT that is paid on anything bought for the business. If turnover of a business is more than 1 million per year, then the business must be registered as a vendor. Read that theory. Read that theory. Zero rated supplies, read them on page 85. Exempt, also read. Financial services are exempt. Donated goods are exempt. Renting, dwelling rentals are exempt. Passenger transport is exempt. Educational services is exempt. Then what is input VAT? Is paid by a supplier for goods bought for the business. Output VAT is what is charged by a vendor to customers. What customers pay to you is what is called output VAT. What you pay to your own suppliers is input VAT. VAT payable is the difference between these two. Let's look at illustrative example on page 122 of your textbook. Let's look at example 1 on page 122. The farmer sells for 100. So he is going to charge 14% of 100, which means the output VAT is going to be 14% of 100, which is going to be 14. So the tax due to SARS is going to be 14. The manufacturer now sells for 500. He had paid 14 to the farmer, but he is going to charge a percentage of 14%, which is going to be 70%. So the difference between, which is going to be 70 rands. If you say 500 times 0.14, which is 500 times 14 is 70. So the difference between what he paid and what he is receiving is going to be 56. That's what he's going to, that's what he's going to, what he received from his own customer is 70 and what he paid is 14. The difference, which is 56, is what is going to be due. We continue that way until the end. So please go through that and understand that. We have talked about perpetual inventory. We talked about periodic inventory. We have looked at those examples. Budgeting. They didn't say anything about budgeting there. But what is a budget? It's a plan expressed in monetary terms. It is based on past experience. Master budget is something like a trading profit and loss account and a balance sheet. It shows budgeted statement of profit and loss and statement of financial position. That's a master budget, but it is a forecast of what you expect to. Operational budgets are different. You have the sales budget, production budget, direct material usage budget, direct material purchases budget, direct labor budget, manufacturing overheads. Sales and administration expenditure budget, you look at what you are looking at. Inventory budget deals with direct materials, which is raw materials. It deals with work in progress. It deals with finished goods. Fixed budget, those that are prepared and they can never be changed. So we are saying a budget that is prepared for one level of activity and does not change when the level of activity changes. It is static. They are rigid in nature. That's what a fixed budget is. Flexible budget, you'll find that on Learner Guide, page 102, there is an example on a 102, page 102. You see, it's flexible. It's on page 102 just below. They show indirect labor where they are showing you the budgeted and actual. The difference between the two is called a variance. For instance, here they had indirect labor. They had budgeted it at 97,600, but it was 120,475, which means there was an unfavorable. If you are spending more than what you had budgeted for, we say it's an unfavorable of 22,875. But for instance, in repairs, they budgeted for 2,440 and they spent 2,379, which means it was 61 favorable. You continue that way. For depreciation is fixed, it's the same. For fixed overheads, it was the same. So there was no favorable, unfavorable. That's a flexible budget. Cash budget. Cash budget, I already explained to say it looks at how much has been used, where the money came from. A good example is on page 200 of your textbook. I'm trying to push for questions later. That's why I'm trying to have us cover this. Please go through that example. You'll find that mostly what you have to understand in a cash budget, they never said anything, but it might come on multiple choice questions. For instance, they might ask for a data schedule. You should know when you sold the goods and how you receive your money. They might tell you in the month of sale, you receive so much, next month you receive so much, the next month you receive so much, and come out with the collection schedule. And then the cash budget will look exactly like something that you are seeing on page 202. 202, you have your opening balance, then you have cash receipts. Cash receipts can come from your sales, and then receipts from debtors. Receipts from debtors might be coming in a different way. You have to come up with your debtor schedule. Then you say less payments, and then you get your closing balance. The closing balance is always the opening balance of the next year. Now, ladies and gentlemen, I deliberately left about 15 minutes for questions. Any questions? I tried to fast track. It's long. I would really say those that are in Joburg, it would have been good for you to come for the, for the workshops. They would have helped a lot. Any questions, ladies and gentlemen? I tried by all means to be as simple as possible. I hope my pronunciation and everything was okay. Mokete, I noted that you were a bit, Ramokete, you were a bit confused by the, average weighted cost of, by the stock valuation of average weighted average cost. I'm now waiting for any questions so that if I can, I address it. Ramokete, please go through that. Note that when you are using weighted average, what we do is we look at how many units they were, how much they were, we add the number of units, we add the number of the total, then we divide and use the average cost. Yes, thank you so much, guys. I'm happy you found it. Please, next time, do come for the workshops. Thank you, Cleo. Thank you, Elaine. Liquidity ratios, no, they are not here, my dear Elaine. They are not in your syllabus. Thank you. I'm happy, Roshan. I'm just worried about Romohete. I wish I could meet him when I'm around here and help him. Oh, Cleo, you're in Zim. Oh, it would have been good, Cleo. Harare or Bulawayo. I can see that. Now somebody is asking about the markup. Markup is when you are relating the profit to cost, and margin is when you are expressing profit as a percentage of, sales. Okay, Bulawayo, that's my hometown. Thank you, Sharon. The video, I'm sure, Genevieve is going to give it to you. Wesley, yes, I think the slides are going to be available, my dear. Just deal with Genevieve. Genevieve is the lady, is the boss that is in charge of that. Yes, they are going to be available, Wesley. Elaine, yes, they are currently on. We are only remaining with one Elaine. Thanks, Shay. I'm happy you enjoyed it. Don't go to anything, Lorraine, that is not in your learner guide. Your learner guide is your guide to what you should cover. Okay, Lorraine? Thank you, Semi. Thanks, Lorraine. Okay, are you in Joburg, Ramokete? If you are, please arrange with Genevieve. Cash budgets, I didn't see anything in your tutorial, but they might ask you to just come up with what they comprise, just as I explained it. Harry Smith, oh, it's far, Ramokete. Thanks, Cleo. Thanks, Porter. Have a good evening, people. I know my test isn't easy. I also had my studies when I was an adult, and as a parent, it's not easy. Semi, good luck, everybody. Good luck, everybody. Good luck. Good night. Have a blessed evening. I enjoy this. Thanks a lot, guys. Thank you. Be blessed. And good luck in your exams. Good night. Enjoy your evening too, people. Okay.